Welcome to the Deep Dive, where we take the most complicated financial reports and, well, we try to turn them into clear, concise knowledge for you.
And we have a big one today.
We certainly do. We're tackling the Q2 and H1 FY26 results for Bajaj Finance Ltd, or BFL. And this isn't just one report. It's a whole stack of data consolidated, standalone, subsidiary reports. It's a lot.
Exactly. So our mission here is to really cut through all that numerical fog. We're looking at the disclosures the board approved on November 10th, 2025.
And these have the unmodified limited review opinions, which is key.
It is. It's the accountant's green light. But our job is to figure out what the numbers actually mean for the company's health, its growth velocity, and its big strategic bets for the future.
Okay, let's jump right in then. Section 1. The big picture, the consolidated financial highlights. And when you look at the whole enterprise, the growth story for Q2 compared to last year is, well, it's undeniably robust.
Oh, absolutely.
Assets under management, AUM, grew by 24% year on year. It just soared past the 4.6 lakh crore mark.
Landing at 261 core, to be exact. But it's the velocity of that scale that's really the key here.
What do you mean by velocity?
I mean, they added over 20,000 crore in AUM just in the single quarter. That's incredible speed.
And to support that, new loans booked hit, what, 12.17 million?
At 26% increase. So this isn't just slow, steady organic growth. This is aggressive, volume-driven expansion.
And crucially, this massive scale hasn't completely thrown their profitability metrics off track. Consolidated profit before tax, PBT, grew 22%.
To 6,608 crore. And profit after tax, PAT, was up 23% to nearly 5,000 crore.
But the real test, for any financial services company is the efficiency of that profit.
Absolutely. And for that, we have to look at the long-term guidance BFL has set for itself. They're aiming for a sustainable return on assets, or ROA, between 4.3 and 4.7%.
And a return on equity, ROE, between 19 and 21%. So how did they do in Q2? I see they hit the low end of that guidance. Annualized ROA was 4.5% and ROE was 19.1%. Now, why is hitting the low end actually a huge positive here?
That's a great question. Because in this climate of, like we said, explosive growth, maintaining an ROA of 4.5% shows immense discipline.
Okay.
ROA tells you how effectively they are turning their assets, their loan book, into actual profit. If they were just expanding recklessly, chasing market share with cheap or super risky credit, that ROA would just plummet.
So it dragged their efficiency right down.
Exactly. Hitting the guidance range, even the bottom of it, shows this high volume expansion is still controlled and, most importantly, profitable.
Got it. So beyond profitability, let's check their defensive wall, their balance sheet. As an NBFC, that capital cushion is just vital.
And it remains very, very healthy. Their capital adequacy ratio, CRAR, stood strong at 21.23% as of September.
And tier capital, the core cushion.
That was at 20.54%. So comfortably above regulatory requirements. It gives them plenty of room to keep lending this aggressively.
Okay, so that's the scale and the strengths. Now, for the tension point, the headwind that was clearly flagged in the report summary, credit quality. Where are we seeing the pressure build?
The primary pressure point is the credit cost. It's remained elevated. This is basically the cost they expect from potential defaults.
And that's showing up in the NPA numbers.
It is. Their consolidated gross non-performing assets, or GNPA, rose to 1.24%. That's up from 1.06% a year ago.
And net NPA.
NPA also rose up to 0.60% from 0.46.
So we've got explosive growth on one side and this slightly rising risk on the other. How should we read that? Is this just manageable growing pains, or is their risk engine starting to strain?
It's the tightrope walk. At 1.24%, they are still within their internal guidance corridor, which is 1.2 to 1.4% for GNPA. But it's the upward trajectory that needs constant watching.
Because they're growing fastest in riskier segments.
Precisely. And it looks like some of that risk is starting to materialize. The big question is whether the revenue from that higher growth is enough to compensate for these elevated credit costs.
That makes perfect sense. Okay, let's shift focus to the core engine. We've looked at the whole consolidated picture, but sometimes those big numbers can mask issues. Before we add in the subsidiaries, does the standalone performance of Bajaj Finance Ltd tell a different story?
It does, actually. The standalone entity, so the parent company on its own, shows equally strong momentum, but with a slightly higher inherent risk profile, and that's important context.
Okay, so standalone AUM,
grew 23% to 338,121 crore.
And profitability.
The core profitability is solid, but we have to make one adjustment here for you to get a clear picture. Last year, they had a large exceptional gain from selling some Bajaj Housing Finance shares.
A one-off event.
Exactly. So if we exclude that non-recurring income, the standalone profit after tax actually increased 24% to 4,251 crore. That gives us a much cleaner look at the operational growth.
You mentioned a higher inherent risk profile for this standalone core. What do those numbers look like?
Well, the standalone GNPA stood higher at 1.59%, and the NNPA was at 0.77%.
So definitely higher than the consolidated figures we just talked about.
Right, which reinforces the fact that some of their subsidiaries, especially the housing finance arm, are actually pulling the overall group risk profile down. The core lending business itself carries a bit more risk.
And how prepared are they for that? What's their provisioning look like?
Their provisioning coverage ratio on Stage 3 assets is at 52%.
Can you quickly break down what that means for us?
Sure. Stage 3 assets are just loans that have already gone bad. They're non-performing. A 52% coverage ratio means for every 100 rupees of those bad loans, they've already set aside 52 rupees to cover that potential loss.
So a pretty healthy cushion, even with rising risk.
Yes, it shows they're being prudent.
Okay, before we dive into those subsidiaries, let's just quickly touch on the equity restructuring. It was a massive change for anyone holding the stock.
Yes, a crucial footnote for investors.
Yeah.
It fundamentally changed the share structure. First, they did a subdivision, which cut the face value of each share from 2 rupees to 1 rupee.
And then the bonus shares.
Then they followed up with a big bonus share allotment on June 17th. It was 4 bonus shares for every 1 share held, a 4-for-1 bonus.
And the goal there is just to increase liquidity, make the stock more accessible.
That's the idea. It dramatically increases the number of shares out there, which can bring in a broader base of investors.
Understood. Now let's talk diversification. How does the AUM mix show us where their strategy is hitting? Where's the really explosive growth?
Well, mortgages are still the biggest piece of the pie, about 31% of AUM. But the strategic pivots, you can really see them in the extremes. This quarter highlighted 2 massive growth engines they are intentionally fueling.
And which segments are those?
CV and tractor finance, so that's commercial vehicle and tractor lending, grew by a massive 534% year-on-year.
Wow.
And microfinance, or MFI lending, grew by 217%. This isn't just organic growth. This is a strategic push into high yield, and you could argue relatively untapped markets for them.
But both of those carry inherently higher risk than, say, prime consumer loans, right?
Much higher volatility and default risk. And that connects right back to why we see that underlying tension in the overall NPA figures. It's a trade-off.
That context is vital. And on the flip side, we saw their captive 2- and 3-wheeler finance segment shrink by 49%. That's a sharp pullback.
It shows they're being ruthless about reweighting their exposure. They're moving capital away from segments with maybe lower returns and pushing it hard into areas where they see maximum growth potential.
Even if it brings a slightly higher risk profile. So let's talk about the stabilizing force in their portfolio. Bajaj Housing Finance, or BHFL. Housing finance is generally seen as the safer bet.
And BHFL is definitely the anchor here. Its AUM hit 126,749 crore, up 24%. Payday grew 18%, but what's truly exceptional is the asset quality.
How good is it?
It's near immaculate. GNPA at just 0.26% and NNPA at a tiny 0.12%. This exceptional stability is what helps counterbalance the risk from those other faster-growing segments.
Okay, but if the asset quality is so pristine, why did their loan losses and provisions spike so much? It went from 5 crore last year to 50 crore this quarter. That's a 10-fold jump.
It is a huge jump, and it's a really important nuance to unpack. It actually signifies heightened prudence in their provisioning.
So it's not a bad thing.
Not necessarily. The report notes that last year's 5 crore figure actually included a 25 crore release of a management overlay. They were booking a profit from provisions they no longer needed.
So the comparison isn't apples to apples.
Not at all. The spike to 50 crore this quarter shows a conscious decision by management to significantly ramp up provisions, probably as a proactive move against future uncertainty, even with their current low default rates. It signals caution.
Fascinating. So what looks like a higher cause is actually a sign of better risk management. Okay, let's move to the capital markets arm, Bajaj Financial Securities, or BFSL.
BFSL is just continuing its rapid customer acquisition. They added 94,000 customers this quarter.
Taking them over the million mark.
Right, to 1.15 million total. That's 38% growth. Their AUM grew 40% to about 7,600 crore.
And what's driving that AUM growth?
It's largely fueled by margin trading financing, or MTF, and ESOP financing. So customers are borrowing against their securities to leverage trades.
And the profitability is there.
It is. PAT increased 27% to 47 crore, so that expansion is paying off.
So we have scale, we have diversification, robust subsidiaries. But underpinning all this high-volume lending is BFL's aggressive digital strategy. BFL 3.0, they call it the FineAI company. What does FineAI actually mean?
FineAI is their internal term for integrating finance and artificial intelligence. And it's not just a buzzword.
Yeah.
They're using AI to fundamentally transform the entire lending lifecycle.
Not just for chatbots.
No, not at all. It's for everything from predicting default risk to automating disbursements and scaling up their compliance checks.
And with over 110 million customers and, 241,000 points of sale, they desperately need that automation.
That scale is precisely why they need AI. Their goal is to launch 80 high-impact AI use cases by the end of February 2026, and we're already seeing really concrete returns.
Okay, give us the tangible results. Where is the AI actually hitting the bottom line?
Okay, look at personal loan disbursements. AI voice BOTs contributed 1,980 crore. That's 18% of all personal loans done through their call centers.
That's a phenomenal efficiency gain.
It is. And on the service side, 85% of Q2 customer service resolutions were handled by AI-powered service BOTs. The cost difference between that and a human agent is night and day.
And crucially, how is this AI impacting the risk side that we were so concerned about earlier?
That's where the tech really meets the risk. AI performed quality checks on 42% of all loan applications. This is what allowed them to process something like 6.5 lakh. That's 650,000 applications in a single day during the festive season.
While still maintaining quality control.
Exactly. The AI gives them the speed to capture that festive sales volume without sacrificing the diligence that prevents defaults down the line.
And speaking of the festive season, the company did confirm that this operational power translated directly into sales, with a 12% increase in consumption loans versus last year.
Right. It validates the massive investment in FineAI as a core part of their strategy, for both scale and for risk integrity.
So to bring this all together for you, the listener, BFL delivered explosive growth in AUM and new loans while keeping its profitability strong enough to hit its long-term guidance. This aggressive pivot into high-velocity segments like MFI and CV lending is driving that growth.
And that digital FineAI transformation is providing the operational edge they absolutely need to manage it all.
And crucially, the impeccable asset quality of their housing finance arm is acting as that necessary counterbalance to the slightly rising overall risk profile that we're seeing in the standalone core.
And that rising consolidated GNPA of 1.24% is the single most important metric for you to keep monitoring, especially with this rapid AI deployment. The question for the long term is whether the tech-enabled speed fully offsets the inherent higher risk of pushing into those explosive segments like CV and MFI lending.
So they have to maintain that strong provisioning coverage.
They must. That 52% on stage 3 assets is their buffer. As they keep relying on AI to process hundreds of thousands of loans a day, you should watch how successfully they can scale at this speed while simultaneously tightening risk monitoring in what is, a constantly fluctuating economy.